Hey everybody, welcome back. Well, we have the ES here today, and I just think there's a couple really key things to look at. First and foremost, RSI got back up to that 70, and then we kind of came right down, didn't we? Now, we're still talking about this bar, and I feel like we've been talking about this bar forever. And that is when we started seeing all those CTAs sell in here, and it ties right into that July 11th bar where CPI was negative for the first time. And if you watch this channel at all, you know how I feel about macro events. And how they shape what we trade. And everything here so far has been a macro event that has really moved us. That's really how the tone sets. If you watch this channel, you'll understand that. This was when they said we're going to stop raising rates. And of course, if you remember back in here, this is when he said we're going to stop buying up the world, and everyone realized they owned an NFT and it was really just a JPEG. And then if you go back to here, this is where they said, hey, we're going to direct trillions and trillions of dollars in the market and make you think the market goes straight up forever and lure you into a false sense of security before we pull the rug. And then right here is where you had peak CPI. And this is where you had the weakest CPI. And you can see why I'm concerned about that area. Just like when you had peak CPI here, it was an issue for the bears. Now, where this is leading us to is we're seeing some flattish action going in here. We have non-farm payrolls tomorrow, and you have a lot of signs already on what non-farm payrolls are going to be. I'm basically going to give you a roadmap in here on what you need to watch tomorrow and then the expected move, etc. But if we're just looking right in here, what we're seeing is we're already pretty much sold down to that oversold position going into the number. So could it be weak? Yeah, but we already worked off the overbought, didn't we? And we didn't drop that much. We dropped some, but are we really down that much? Not really. If you look in here, and we just drop this off for a sec, you're really in the same exact range, aren't you? I mean, you're really not going anywhere. And so what you want to do here is you just want to watch these levels and just pay attention to them. This 57.25, 87 seems to just be its nemesis. And then, of course, you're trying to get through that 30 and stay above it. And you're just really having a real tough time up there, that 58.30. So this is where we are, and this is what we have. If I do the simplest of things, and I use this private cloud, which I tend to use in this kind of environment, I'm definitely getting a negative bias with the cloud. And I'll just show you this really quickly. So if you look right here, you have pop, pop, pop over and again, and then we flip the cloud and the cloud becomes yellow. There's a couple things here that I'll just point out with this, just so you can understand it. All three parts of the cloud crossed here on this down bar on October 1st. That's pretty much a telltale like sell signal to me on this. And we've been playing the market just trading around more than anything about it. A couple swings that have done well, and I'll show you a couple areas out there that you should be paying attention to that are on absolute fire right now. And it's kind of interesting. It makes me wonder what's going to happen if this does actually turn. But you can see how this cloud just can't get above it. So whenever I see this, I just kind of put the brakes on and I start looking at the short side a little bit more. But we're not breaking this level either. I mean, we all know some of these levels that are out here, this 2 p.m. level. It's not really that significant on the futures market, but this is where Powell came out and was talking and said, no rate cuts for you. And everybody said, oh, I thought we were getting 150. And he's like, well, maybe you'll get 50. Kind of crazy the way these guys talk, but it is what it is. He wasn't that blatant, but he might as well have been. So now we're just not being able to flip that cloud. And you can see these levels in here. Clean all this off and just go back to the basic chart for a second. And you just see what bars are in control of the entire market. This is where they mark to market all their trades before the end of the quarter so that all the mutual funds and hedge funds could look like they were super smart. And then they just convinced retail that we were going to go up forever, and they just dumped right onto retail. Okay. And if you take a look at that bar and you just mark this bar off, the things that you will see, just by marking off the open, high, low close of control bars. So if you look at that close of that bar on the hourly, how many times have you made a higher high above it? Never. How about never? So what would be a good start here? Would be to make a higher high above this and then go, okay, well, maybe we can attack up to this level. I would watch that very closely because you just have not been able to. But then at the same time, you are developing this, and this is becoming somewhat of a concern of mine. Wicks are price rejection. Do you see how the wicks right here? See how the wicks start going away here? See how the wicks start completely away here and those wicks start getting lower? See how the wicks start going to the upside here? Okay, so you have a change in trend here, don't you? Even though you're in this trading range. In other words, wicks are what? Price rejection. I have no rejection here. They're like, no, just keep selling. We're fine. No, no. Do you have buyers up here? No, no buyers. You had buyers before. So this could just be we're tightening up because of going into tomorrow. But I would watch that level very, very carefully and go from there. Now, let's take a look at what to look for tomorrow. And then after that, we're going to get into some specificity about some names that look like they're going to just really rip here. So let's talk about why they are so comfortable with tomorrow's non-farm payroll. And then we can talk about if they have a reason to be or they don't have a reason to be. But I think it's kind of important just to say how are they getting there. So this ADP employment change right here, 143. This is the previous, and then this was the estimate. So we had a change in ADP employment that was higher than expected. And this is important because ADP deals with private. Now you have three parts of non-farm payrolls. You have the private side, you have the manufacturing side, and you have the government side. The government side is the easiest for them to manipulate. As we've seen in the past, they will come out and just do a hiring freeze or something along those lines, or do a hiring binge to make the numbers look good. But this ADP employment change is about as significant as you can get because it's ADP pulling directly from their clientele on the private side. Now, this was both good and bad, and we'll explain it because Bloomberg did a really good article on that. And the private payrolls was 143, so the headline tomorrow, the reason you're seeing the bond market do what it's doing is the headline tomorrow, okay? And now you're seeing stronger hiring didn't require stronger pay growth. So while they're hiring, they didn't need to pay out more money. Now, this is the first sign that there might be an issue because usually if somebody moves a job, you have to give them more money. Now, just to go through a couple key things here, hiring at U.S. companies picked up in September, 5-month stretch of lower payroll growth, increased 143. Was the weakest since March 2023, according to the ADP Research Institution with Stanford Digital Economy Lab. Bloomberg survey called for 125. And the graph does a really good job showing this. So if you look here, you can just see how we've had this decline from March straight down, which is scaring people a little bit. It's very different than what we had before. And I think they're using a 3 as far as the moving average on their change, and that gets you right around that 119 is where they're at right now, probably averaging in about three months is what I'm thinking they're saying there with the 3. Nonetheless, if we take a look at this, what you're noticing is this 143 from here starting to curl up, and that could be a good sign if we can get somewhere around there. But this is far from where we were in 22. Now, the question is, should you be up here or should you be down here? Well, you probably should be closer to something where this median line was, probably closer to something around 200. And this is the rub, and this is what they brought up. Separate data out Tuesday showed job openings unexpectedly increased. And this is the JOLTS jobs numbers that came out. If you remember, they came out at 8 million. And this is all really important because it's showing like, hey, we have more job openings than we thought we had before. The ADP's going up. And this, in August, the hiring rate matched the lowest reading since 2013. And I just want to point that out, excluding the onset of the pandemic. Another gauge from the ISM showed that the smallest share of respondents increasing manufacturing employment. So you remember that what we just talked about, you have private, you have manufacturing, and then you have government. Well, they're saying that the institution supply of management showed the smallest share of respondents increasing manufacturing. So is manufacturing going to be down again? And we really don't have an answer to that. Now, there is a strike going on, but none of that will be in here because this is all backward looking. Stronger hiring didn't require stronger pay growth last month. Chief economist at ADP, typically workers who change jobs see faster pay growth. We didn't see that. They just were happy to have a job. It's very different than before. So this is something that we have to monitor, that people will be looking at. And this might be reflective in non-farm payrolls one way or another tomorrow. Meaning the reason people are taking those jobs is because they realize like, hey, I'm out of a job. And now I can go and get one. Sure, it's the same pay, but it's better than nothing. And there might be some of that. But you start looking at the initial jobless claims and why the consensus was 220 and you came in at 225 and you're in that range. It is higher than we had before. But challenger job cuts are down. So we actually are getting a little bit of mixed data. Now, this is where it gets really interesting because we do look at the S&P Global Services number. And that 55, that's a really high number. Usually 45 is contraction, 55 is expansion where you're actually raising rates. It was interesting. There was an economist on Bloomberg this morning and they mentioned this. Never has the economy been in such good shape where they've cut rates. The question is to why. And maybe there's a lot of reasons for it, but I know that people think it's going to get worse. And maybe it does. But this is what we have right now. ISM Services PMI is 54.9. 55 is an overheated economy. Okay? Our consensus was 51.7. And that's why the market moved when it did at 10 o'clock today. And this is really important to get because the services side of the business is booming. I mean, it's literally expansion. It's almost too hot when it's over 55. And if we go through these other numbers just very quickly and just look and say services business activity, previous was 53, we're at 59. Services employment, 48.50. New orders on services, 59.4 versus 53. Service prices are up to 59.4, 57. These are not recessionary numbers at all. So you have a lot of mixed data. And the last piece of data we have that's really important for our non-farm payrolls is that ADP number. Tie that together with services, and that's why people are selling bonds today. And you'll see it right in here. As soon as that data hit, and I was waiting for them to update this. Now, you're going to think it's not a lot, but for those that don't know, this is CME Fed tool. And what you can see here is there's a 100% chance of a cut coming in November 7th. But this little movement here, just that one piece of data that came out today it's really an ancillary piece of data, shifted us. We're 475 to 500. And that shifted us from a 64 to 66.8% chance of one cut versus two. And it dropped the chances of a 50 basis point cut by about 5%. Just that one piece of data. Now, people look at these numbers and go, that's not a lot. That's not even a substantial piece of data. That's not even non-farm payrolls. So let's say non-farm payrolls comes in tomorrow and it comes in hot, meaning it comes in line or better than expected. You're going to see bonds sell off, and they're going to sell off, and that people are going to want to watch this. Now, the big things to watch tomorrow, obviously, are going to be the 142 number. And what we also want to watch is that unemployment rate. If you ever saw 4.5, just write this part down. If you see 4.5, market's going to drop like a stone. If you see it for any reason, just understand that that is, hey, we are probably heading into recessionary times. It's going to be a huge move. No one's going to feel warm and fuzzy about that. If we take a look here at the previous non-farm payrolls number, 142, consensus is 140 coming into this. Now, if we go through these numbers, government can always play with that number. Always play with that number. Manufacturing last time was negative 24. It's supposed to be 0, came in at negative. And this time we're looking for negative as well. The private side consensus is 125, previous is 118. This jumped last time. So we're expecting private to be higher. We're expecting it higher to be the estimate. The weak part might be manufacturing, and government can do whatever they want. They've done hiring freezes and they've done hiring binges before to play with this number. And you can go back and look at that first. You can literally click on these on trading economics and drill into that number. But you're going to want to watch this as well and just say, hey, are hourly earnings up or down? Well, according to that data, we just want to make sure they're in line. But the big dog is going to be this. Now, if you are too hot, way too hot, then you're going to see, meaning too high, then you might even see equities drop. But you will certainly see, if you're too hot, you're going to see, without a doubt, you're going to wind up seeing, if you drop a lot, you're going to see a big move there in the bond market as well. This needs to come in line. You need to come really in line, or the bond market's going to be violent one way or another. Anything too weak could trigger a recession in people's heads, and you could see equities drop. So this is a really big deal. They're estimating a 1% move. I personally think it'll be bigger than that, but it's definitely something for you to watch tomorrow at 8:30, and we'll be live for it as always for the pre-market. Now you're all prepped for tomorrow. One of the core trades that you want to focus on here, this is a very simple trade, and I'm trying to keep these videos more specific to actionable events. But this is getting really obvious to me that this is what we're doing in some of these names. So I just want to show you it. And then you can go and do this for yourself. You're seeing this in a couple different places. Does it always work? No. See right here, this is the 55. I use a 55, not a 50. See how you undercut here after that open? So if you look at this August 15th, there's an undercut there, and then you flip and you go. So you open, then you undercut, and then you rip and close over it. You open, you undercut, and then you rip and you close over it. Same here as well. Same here as well. Okay, when you see this, specifically, when you see this where you even have a breakout and then a retest of the breakout of that area, you want to pay attention. So we have a trade on, or I've had a trade on, I should say, in the video for a long time as a swing. We're doing fairly well with the swing, and we're doing really well with the calls. We have calls going out for a while here, but out to end of November or mid-November roughly. But you see the level that you're at sitting in here? All right, so now look at it this way. And then you come in the next day, and let's get rid of this pre and post so you can see this super clear. And let's get rid of this level right here. And what I want you to see is these undercuts. And you can see them right here, right? The undercut, the shake and bake, and then we rip and roll. So when you see this kind of stuff, and we all know what that level is because we just went through what this level is here, and you can see that level very, very clearly, I would suggest that you consider putting a 55 on a chart with an open, high, low close and seeing if it makes a difference in your trading. You can always compare it to the 50. Some people say that there is no difference. That's what people, but there's a difference. You just have to get used to it. So if you watch this level right in here, right, if you use what everybody else uses, you're going to get the same results as everybody else. Everyone else doesn't really know what they're doing, do they? So if you watch how this is acting right in here, right, what do you want to do? Right, you want to look for these kinds of levels because when you find them, you want to get involved. See the rip and then, the rips you down and then goes. All right. So what you're doing with this is you're just noticing it and going, oh, okay, so they undercut, tripped everybody's stop, and they ripped you up. If they kind of milk toasted you up and then rolled back down, you have a problem. That's not what they did. So at the end of yesterday, we bought more calls. Let me show you. I really don't like when I say this stuff. And so this is yesterday, and you can see it right there. These are, I'm into the November 15 one. So after that, one of the core issues for me is, okay, what am I going to do with it? So I'm staying with it, and then I'm fine. And then Biden, in his infinite wisdom, says, well, maybe we are going to blow up some things in Iran. And then all of a sudden, the market drops. That is not a political statement. That's basically what the guy said. It's not off the... And that's when you saw the market drop. Okay, so once that happened, people just looked at this and said, you know what? I'm going to stay out of the way. Whether you got out of it there or not, doesn't matter, but you would have to agree with me. And if you don't, I'd love to hear it in the comments. But you would have to agree with me that that is a control bar. What happens if you mark the close of that 5-minute bar? Okay, isn't that another Christmas miracle? Where else did we just see that? On the ES on a daily chart for months, okay? These control bars are real. You might not believe in them, but that doesn't mean they don't exist, right? Very different than Santa Claus. So if you want to watch these levels, it might not be the worst idea, but when you are near something like this on a daily, you want to pay attention to this, okay? You want to pay attention to those 55s and you want to pay attention to those undercuts. It will greatly help you when you're trying to get in these names and try and stay in them. Another one that we did like this, and I'm bringing this up specifically because it's this kind of a trading environment that you're in right now. People will call it a kangaroo market, whatever. When you're flipping these 55s, the undercuts, and then you're flipping, that's what's working. It's the undercuts. Let me show you the difference here. And it doesn't mean that I might not do the trade. On this undercut right here, I'm going off script a little bit to what I want to go over, but this is really important. Opens, undercuts, rips. Opens, undercuts, rips, right? Okay. Never opened an undercut. I still did this trade. This was a loss. Opens, undercuts, rips. I did this trade. We got in at like 51, 48, 51. I have to go take a look. But we got out of the majority like right into here. That's the other thing. You have to sell into the higher end of the bands. If you don't, you're going to have an issue in this kind of market. Please understand that. Now, I would strongly suggest you start looking for these kinds of trades in this market. And not only there, but start looking at them in the sectors, okay? Undercut, rip, anywhere? Yes, right here. And you can say it. Say it. Opens, undercuts, rips, higher high. Now you're going to non-farm payrolls tomorrow and it is going to be nasty. But here's the thing to look at. I have a huge TLT trade on. I've had it in for a while. I actually have had some in now for about a year, and I wonder what we're up on that on the year. I left this on in November. Where are we? We're still up 11% on that. So, and then we have another trade on. I'm not crazy about going into tomorrow. I don't think we're getting the rate cuts that we're going to see. And you saw a tremendous amount of put buying today. This could get ugly tomorrow if it's a really high number. And so you're going to want to watch the bond market's reaction to that very, very carefully. Specifically, also watch TMF because you can always short that if you're looking for something to do. But right now, as you're breaking that 55, they're telling you, they're telegraphing you that this is the issue. And we want to be aware of that. Now, as far as specific names that I would look at and tell you that I think you need to pay attention to, there are two major sectors that you really have to pay attention to. VST for one, and this is something that we've had a position in since it broke out. We actually had a position back here, and then Powell scared me because of the rate cuts and the hoople heads. But once again, back in, traded around it, and now we just have this long position on. I actually added to a bunch of stuff today, and I'll just show you the ads because I hate saying that when stuff's up. And then you're like, yeah, of course you did, Boomer. But we bought yin, and I'll go through this and why you should look at these specific names. And you can take a look at them. What I'm getting at here is the following. These kinds of breakouts, when Google's telling you we're going to do nuclear power, and these are the companies that Microsoft's using, like CEG, you break out, you've never looked back, and now you're hitting new highs, and the volume's picking up, you want to look at this space. There are three names, and I've shown this out there before, and if you're in the community, you're fully aware of this. If you're not, there's a wait list that's back open. Get on the wait list because I'm going to open it up again for a very short period of time before the end of the year. But you break it down. You break down your AI power by how this is going, right? So you have your backup power, You have your commodities that are going to be affected, the unregulated utilities, the data centers that are benefiting. So when it comes out and the group moves, you know what's in that group, right? I'm pretty organized like that. And then so like we know that, oh, the CEG's moving. All right, start looking at VST. And people, for some reason, aren't looking at NRG. And our NOG is like the easiest trade in the world. It just keeps grinding. So it's very simple. You want to look at this. The other thing that those three names, the other thing I really want to hammer home here, guys, you don't give up on these because they're pulling back. They're reinflating the equity trade here. We're going to talk about this on Saturday. Make sure you watch Saturday's video. They're reinflating the entire trade here. They're reinflating their market. So one of the only markets that's going through reinflation is China. Yen is a really very simple way to trade these all. The other sectors and the other names you must be looking at here is you have to look at these financial names like TIGR, QFIN. Okay, look at how they acted today versus some of these other names. Right? Look at FUTU. These are the names that are going to work. They are those fintech names that used to be very hot. We'll talk more about this on Saturday. That's it.